let's go ahead and begin. Okay, so the inflation assignment is due on Monday next week. You have some time over the weekend to continue working on that. And then after you've finished homework 13, your focus should be undivided for the project. It's a pretty important part of the course, and it's where you're having the opportunity to really apply a lot of what you've learned, and it's worth a big part of your grade. So I'll be continuing to answer questions via email, and if you want to get in touch with me over Teams, you can always reach out and try calling me on Teams, and I will always pick up if I'm available. So today we're going to continue talking about inflation and present worth. This still is from chapter 14 in the textbook if you're following along. Before we begin with that, are there any questions related to these announcements? Okay. So this is some interesting data that shows the effect of the pandemic back when it started in March. When it really had its effect in the United States was March. A lot of people in my generation were really affected by the recession that happened at the end of the last decade. So in the end of 2008, 2009, there was a recession, and I mean, it just dominated headlines. There was the collapse of a couple of really prominent insurance companies, and banks were threatened, and it looked like maybe the U.S. economy was going to suffer a huge loss. And in the end, there was some federal and central bank intervention that pumped money into the economy and propped up a couple of banks that were unstable. And they avoided really serious damage, but there was just all kinds of newspaper and radio stories about people who were being forced out of their homes because it was a housing crisis. It was the issue that caused this recession back in the end of the last decade was that people were buying houses much bigger than they could actually afford. There was a bubble of easy credit, and so people would get what were called colloquially liar loans, where you didn't really have to provide any documentation proving that you had certain income. You just would go to a bank, you'd tell them what your income was without any documentation, and then they would give you a gigantic loan that you really didn't have any hope of paying off. But a lot of people who did that either were doing it just because they were irresponsible and didn't care about the consequences, or because they thought what they would do was buy the house, let it appreciate in value, and then sell it before they got too far behind on the mortgage payments. And so they were thinking that they would own the increase in its value and then they'd be able to pay off the loan. But of course that house of cards kind of collapsed when housing prices plummeted, and as the housing prices went down, then that had an effect on all of these people who were now stuck with payments that they couldn't afford. So there was a recession, and the effect of that recession was definitely a noticeable increase in jobless claims. This is a graph of the initial jobless claims, and so it doesn't show the total number of people who are unemployed in the United States, but it shows people who are just now going out of work and they're filing their claim for unemployment for the first time. And so what you can see is that there was a rise during this recession, but it's just absolutely dwarfed by the unemployment claims that were filed at the beginning of this pandemic. And so it's completely 22 million off the charts compared to, in the past, what we thought of as a recession was an increase that didn't even achieve 1 million new jobless claims in a week. So we're going to talk in part today about how unemployment affects things like inflation. And I just wanted to put into perspective how dramatic these last couple of months have been, because when you have such uncharted territory and so many people out of work, it really has the possibility to introduce a lot of instability in the economy. Some of the normal rules and phenomena that we think of, the cause and effect, that we're pretty comfortable, that we think that we understand the economy, that all flies out the window when you have such an imbalance in behavior, like suddenly 22 million people out of work. So in our earlier lecture, somebody asked, is deflation bad? And at first glance, you maybe would be tempted to think that deflation is a good thing. We haven't even defined deflation, but you can probably guess that it's the opposite of inflation. Remember, we've been talking on several previous occasions about inflation, and what that is an increase in the prices of goods. So the opposite of that is a decrease in the prices of goods. And so, I get pretty excited when I drive by the gas station, and instead of $2.09 the other day, I filled up for $1.79. And I mean, it's not that much. It saved me a couple of dollars, but I was excited nonetheless. And so if you're buying things, you like it when prices go down, right? We're all excited about Black Friday and being able to finally get that digital air fryer that you've had your eye on for so long. But deflation as an ongoing trend is actually pretty dangerous and destabilizing, and we'll talk about why that is. Here's a picture of people kind of just milling about the unemployment agency. This guy looks particularly glum. But deflation is a spiral that it's hard to know exactly what starts it, but once it begins, it's self-reinforcing. And so it's a decrease in the prices over time. And what it means is, instead of money becoming less valuable, which is the normal thing, the normal thing is that prices are going up, and therefore the purchasing power of an individual dollar is less. So the $1 now is more valuable than $1 in the future, because in the future, when prices are higher, you're not going to be able to buy as much as you can buy now. That's the normal thing that we've been taking as an article of faith through the whole semester. But during a deflationary environment, what means is that the prices are decreasing, and so money is more valuable. And think about the incentives that could cause. In cases of high inflation, there are some countries that are notorious for having hyperinflation. Zimbabwe is one, Argentina is another, and in both of those countries, the problem that people face is that the price of food today is very different from the price of food tomorrow. You'll go into the grocery store at lunchtime and the prices will be higher than they were if you went in the morning. And so the opposite of that is deflation, and it gives you a whole different set of motivations. In the case of really high inflation, what people are incentivized to do is spend their money as quickly as possible, because it's not going to be worth as much in the future. But in deflation, the incentive that people face is to hold on to money. Because if money's going to be more valuable over time, why spend it today if you can buy more things tomorrow, or in a year, or in 10 years? So here's the deflationary spiral, and we're going to talk through each of the phenomena that are described in this spiral so that we can understand a little bit better. And I think probably a good place to start would be with debt defaults. We could start at any one of these points and talk about how they all relate, but let's start with debt defaults. And remember, what I had talked about with the previous financial crisis was that people had signed up for these liar loans and they couldn't afford the payments anymore because banks had gotten a little loose. Banks thought it was so profitable to make these loans, because what they would do is they'd make a loan and then they'd sell the loan to someone else. And ordinarily, if a bank was keeping the loan, if they were loaning their own money, then there's no way that they would be so loose. But what a bank would do is they would make a loan and then they would sell that loan as an investment product to a pension plan or to some other investor who was buying a collateralized debt obligation, a CDO. And so the banks didn't really care if that guy can't pay the mortgage, because they're not the ones who are going to be holding the bag. They know that it'll be a couple of years before people start to default, so they would sell off that as an investment and some other person would be stuck holding the bag. So debt defaults. There can be a lot of different reasons why there is a debt default. It could be flooding, and suddenly a bunch of farmers don't have the crops to sell. that they had expected that they'd be able to sell. So that's another illustration of something that can cause a cascade of debt defaults. It could be a hurricane. It could be anything that interrupts business or makes it so that businesses aren't getting the revenue that they'd been counting on, and so now they can't pay their debts. So a default simply means that you're not paying, and so therefore, if you can't pay your debts, then your firm has to go bankrupt. Your creditors will begin to seize your assets. Your creditors will no longer sell you the raw materials that you need, and so your firm isn't able to continue operating. And so those companies that have become bankrupt now need to lay off staff. And there's different types of bankruptcy. Sometimes bankruptcy means that you're completely liquidating the company and that you're going out of business. And there's another kind of bankruptcy where it's just to reorganize, where you're still going to be a viable company. It's just that the bankruptcy process is being used to renegotiate your debts. And there's Chapter 11, which I think is the reorganization bankruptcy. I could have this wrong, but I think that the liquidation bankruptcy is Chapter 7. So, I mean, the numbers don't matter so much as that there's different types of bankruptcies, but in either case, whether you're going out of business completely or if you're just restructuring the company, it's inevitable that a company that's going through bankruptcy is going to be laying off some of the staff. They're trying to trim the fat, reduce the payroll, find ways to economize, and so there are going to be some people who lose their jobs in a corporate bankruptcy, and the ones who stick around likely aren't going to be earning as much as they were before. If there was a labor contract that applied to maybe pilots or the flight attendants when an airline goes bankrupt, the airline may use the bankruptcy as an opportunity to renegotiate the contracts that they had. Auto manufacturers the same way. When they are laying people off, the union and the union members are terrified that that they're next, and they want to see the company survive, and so often they will be more likely to renegotiate the wages they get paid. And so the workers are getting less money because of all this. Some of them are laid off, other workers are getting less pay, and so they are spending less money because there's less coming into their pockets. And even if you're still earning your same salary, the demand can go down just because you're worried that you might be laid off. And so sometimes all it takes is a threat of unemployment to make you begin to economize. And so if you're spending less money, and what that means is the places that you'd previously spend your money are getting less revenue. And so if you were eating out before, and if you were spending a lot of money at the movies, or if you're buying furniture or electronics or cars, whatever the case may be, when there's less demand for all those materials, then it means that the prices are going to be going down. And we've talked a lot about the relationship between demand and prices. If there's less demand, the only way a company can try and grab onto the lever and increase demand is by reducing prices. And so since the company has reduced its prices, then that means they're going to be getting less revenue. And that just plays into the cycle, because when a company's getting less revenue, then it's more difficult for them to pay their debts. So they maybe had taken out loans expecting a certain amount of revenue, and when their revenue decreases, they're not able to make the payments in the same way that they were before. And so this is called a deflationary spiral, because it's kind of contagious. One firm experiencing the effects of deflation can cause a cascade of effects through other industries, and the economy as a whole is far less stable because people know things are going to be less expensive in the future, so they're less likely to spend now. And at the core of all of this is just economic misery. And so central banks across the world try and avoid deflation. They're very aggressive in avoiding this deflationary spiral. And typical central bank targets are that they would like inflation, meaning increases in price, between 1 to 3%. Anything in that range, most central bankers would feel is pretty comfortable, because you're close enough from zero that you don't risk deflation. And so they don't usually target less than 1% inflation. And anything more than 3% inflation starts to get a little bit uncomfortable for savers. And so there's this sweet spot between 1 and 3% that they like to aim for inflation. But deflation is an interesting concept, and it's something that even though we like lower prices on things, you don't want your economy as a whole to be going through the deflationary spiral. So think about some of the exams you've had before. And in concept questions, I will ask you to explain certain things. And so think about, why would demand fall? Why would prices go down? And why would that cause debt defaults? You should be prepared to answer the why linkage between each one of these steps. Not just what is a deflationary spiral, and I do hope you can explain that, but also you should be able to explain each one of these components and the why behind them. Okay, here is a graph that shows savings account rates over about a 20-year period. And what you'll see is that the savings account rates have overall a downward trend. Unfortunately, I should look for a different figure that continues beyond this temporary spike that we saw in the mid-2000s, because things were pretty good then, but they've gone back down since the mid-2000s. The general trend is that interest rates for savings have been decreasing over time. And you've seen this equation before for the market interest rate, also called the inflation-adjusted interest rate. So I introduced this equation on Monday, and what it tells us is that I sub f, the account interest rate that you actually get paid by your bank, enables you to calculate what is your real interest rate, I. And this I is the interest rate that determines whether or not you are getting an increase in your purchasing power. And I think that what you'll find on the homework assignment is that on one of the problems I'm asking you to calculate I, and in that case the real rate of return is negative, meaning that your purchasing power is decreasing over time. And so any time you're earning an interest rate that's less than inflation, then your purchasing power is going to be negative. And so here is the expected savings account rate, just another figure kind of showing a similar thing where there was a decrease in the real interest rate. So expected real interest rate. Now the graph on the left is just the rate that is paid by the bank, but when you factor both inflation and the market interest rate into account, this figure on the right is a graph of I. And what it shows is that since about the last decade, we've been in negative territory, that real interest rates have been below zero, meaning that you're losing money by putting it in the bank. You're getting more dollars, but the purchasing power of those dollars is being eroded more quickly than the number of dollars is increasing. And so that's a disappointing thing, to earn money, put it in the bank, and then it become less valuable over time. But that's where we are. So a lot of investors are chasing yield, going into riskier investments. A savings account is a comfortable place to have your money because it's federally insured. There's an insurance program called FDIC, the Federal Deposit Insurance Corporation. And I think that in any single account, you can have up to $250,000 of coverage, meaning that if the bank goes bankrupt, the federal government will reimburse you the amount of your deposit up to $250,000 for each account. And so that's really reassuring. It makes it so that there aren't runs on banks. If you hear that your bank is struggling, you leave your deposit there rather than immediately withdrawing it, because if the bank goes belly up, then you didn't lose any money. The federal government will step in and pay you the full amount. And So people like to put money in savings accounts, but because the expected real interest rate is below zero, a lot more people are going into putting their money into preferred stocks that offer a fixed interest, or bonds, or stocks, or doing things like day trading, just looking for other places to put money to try and do better than the low interest rates offered by banks. So what the banks pay is known as the market interest rate, I sub F. And that market interest rate can be more than F, meaning that your purchasing power increases, or it can be less, meaning that your purchasing power decreases. So if the market interest rate is less than the inflation rate, then the only way for that to happen is for the real interest rate, I, to be negative. Now, banks, of course, don't want you to be aware of the fact that you're losing money on your deposits, and so they don't quote the real interest rate, and it's not all their fault. One of the reasons they don't quote the real interest rate is just that inflation is always changing, and it's difficult to agree on a good data source for inflation at any one instant in time. It's often much more clear in retrospect, but today, at this instant, right now, I don't know what inflation is this week. We won't know what inflation was until all the data are compiled, and it may be a quarter from now that we have a clear picture of what's inflation. So for those reasons, banks will quote you I sub F. They'll quote the market interest rate, but they don't do you the trouble of calculating the real interest rate. Now, our textbook goes through a couple of different methods for how to account for inflation and future worth. And you're doing this in the project. In the project, for example, you know what your income would be if you were working in a position right now. But you're also going to be finding out what would your equivalent income be sometime in the future. For example, if you're going to be someday a construction manager, you can look up what is the construction manager salary now, and then you can find out after 10 years of cost of living adjustments, what would the equivalent salary be in those future terms for the construction manager. So our textbook is going through a couple of different methods to account for similar things. And what they say is that you can either find out how many dollars you'll get in the future and then pay for things in the prices that they will be in that time, or you could discount both the salary and the prices of goods to the present. Those are kind of like, broad strokes, the two main ways to handle inflation is find out how many dollars you'll have in the future and the future price, or bring it all back to the present and find out how many dollars do you have in today's terms and what are the prices in today's terms. And so what the book says is that you can convert the cash flow into constant value dollars, as they're called, and that means that you're using the inflation rate to find out the equivalent of the cash flow. So you're bringing the prices to today's terms, and then use the real interest rate in calculating the future amounts. Or you can leave the cash flow in those future dollar amounts and then use the inflation adjusted interest rate to find out how many dollars you'll have in the account to buy those items at their future price. So the homework problem that the problems that you have due on Monday, without specifically saying use method 1 or use method 2, I set it up in such a way that you have to get practice using both of these approaches. So remember that today's money is more valuable if we count on prices going up over time. Because of price inflation, that means today's money is more valuable. And the problem is that the dollars we get in the future, that we are getting a return on our investment, those future dollars are less valuable. And so what that means in terms of inflation is that when you do capital recovery calculations, that you should use the market interest rate, I sub F, which accounts for both the inflation that's expected and also the real rate of return, I, that you want to achieve. So when you find out the annual value of revenue required, and that's the definition of capital recovery, then use I sub f in this formula. This is the formula, the ratio of A to P. Okay, so today's in-class exercise, let me bring up the Word document version of that. It's a little bit more clear than this screenshot. All right, here it is. Hopefully you've got these printed out. Our first question is about this bank that's bragging about the nation's highest yield. And one of my banks actually uses that phrase. They're so proud of having the nation's highest yield. And that interest rate that they're paying is 1.25%, which is just really hard to swallow. At one point, many years ago, I had an account that was paying 6.2%. And I liked that account. I liked it a lot. I wish I still had it. But nobody's paying 6.2% anymore. There's only the nation's highest yield at 1.25. But the rate of inflation that we have right now is about 3%. And so here I'm asking, if you deposit $110,000 into this account that pays 1.25%, and then you leave it in there for 8 years, I ask you to go through step by step A, B, C, D here to try and look at what are the implications. You know, what does it mean if you're going to be putting money into an account that pays less than the inflation rate? So I ask you to find out how many dollars will you have, what's the present value of those dollars if you discount it at the inflation rate, and then calculate the real interest rate. That means I, because we're given I sub f, and we're also given f, so calculate I. And then in part D, hypothetically speaking, what would you need to get from the bank if you wanted your real interest rate to be 1.25? Okay, so this will be good, some good practice. I'm going to pause for a second here, allow you to get started calculating, and then as you start to get answers, feel free to type them into the chat box there, and I'll let you know if you're on the right track and have the right answer. Okay, let's take a look at where the numbers are ending up for this one. All right, this lousy bank. All right, so if you take into account the interest rate that the bank is actually paying, then that's going to tell you how many dollars are in the account after 8 years. And so that's why we're using the I sub f. And you put that into the formula, find the future number of dollars will be 121,493. But the bad news becomes obvious in part B. Because if you use the inflation rate, what we're asking in part B is, okay, so this 121,000, that sounds like a lot of money because you only put in 110. But if you discounted that number of dollars to the present at the inflation rate, then that would give you an idea of the equivalent value of those future dollars. And so that we're discounting at an F of 0.03. And what that means is that $121,000 in 8 years is the same as only having $95,000 today. And you know, it sounds great to have $95,000 until you realize that it was $110,000 before you put it into the bank. So you've lost a lot of purchasing power over the course of 8 years. And it seems like pretty minor, right? We're just talking about 1.25% versus 3%. But compounded over time, it's an enormous destruction of the value of your money. Only having 95,000 where you previously had 110. So it really does matter. So now in part C, the real interest rate. So what we know so far is I sub f and f. And we need to find out what's the real interest rate I. And so a little bit of algebra here. Algebra rodeo. We have to rearrange the equation to try and solve for I. And so we factor out I from the right-hand side of the equation, rearrange by dividing both sides by 1 plus f. And here's the formula that we can substitute into and find out what is our real rate of return. And so this negative value means that every year the money is in that bank, you're losing approximately 1.7% of its value. So in terms of purchasing power, you're poorer each year by 1.7%, and it compounds. In the same way that interest compounds, so does negative interest, where you're just perpetually less and less able to keep up with the rising cost of goods because your savings have been eroded. I'm kind of convincing myself here that I need to get the money out of that bank and put it somewhere else. Quite an effective sales pitch to see the actual calculations like this. Now, part D, it says, so what if you wanted a real interest rate of 1.25%? So if you want your I to be 1.25%, and we know F is 3%, then what would that bank need to pay? So you'd need to go on the hunt for some sort of an investment, whether it's a bank account, not likely, or maybe a real estate insurance fund, or a bond, or a preferred stock, something. You're on the hunt for yield. What you need is about 4.3% if you want to bank an increase in purchasing power of 1.25% each year. So for the exam, you need to be able to explain the difference between each of these different rates. You need to explain what real interest rate means and its relationship to purchasing power. You need to explain inflation and what causes inflation and what are the effects of inflation. All right, so that was part 1. Now here in part 2, we're going to do a capital recovery problem. We're spending $550,000 in a crane, and we're going to try and get revenue out of that investment. We have a 5-year time horizon, and we want to receive a 9% real rate of return, and the inflation rate is 5.5%. So now back to this slide, the two different ways here. Leave the cash flow as inflated dollars and use I sub F in calculations of future amounts. That's what we're doing in this second problem. So first of all, calculate I sub F if you want a real return of 9%, and we're taking into account inflation. So find I sub F and then substitute that into this formula and solve for A. We're trying to figure out how much new revenue each year the company needs to book in order to justify this purchase of the crane. All right, well, let's look at the solution for part 2. All right, so first of all, we need to find the required inflation-adjusted interest rate, I sub f. And so if you want to earn a real rate of return, meaning if you want your purchasing power to be increasing at 9% per year in an environment where money is experiencing 5.5% inflation, prices are experiencing the inflation, that is, then you need to earn essentially 15%. So 14.995 is the interest rate that you have to earn. And so then substitute it into the capital recovery equation. Then that means the new revenue that you have to earn each year would be $164,000. And so doing that will ensure that you get the 9% real return on your $550,000 investment. Any questions about the calculations on that? Well, okay, if there are none, and because we're almost out of time here anyhow, let's just look one last time at the announcement. Schedule-wise, where things are going, you have homework 13 due at 11 o'clock on Monday, and then the project is due at 11 o'clock on Friday. So be in touch if you have any questions. Enjoy your weekend, and I will see you on Monday.